In this video, we will cover mutual fund malpractices if fund manager is unfaithful. Investors in mutual funds repose immense faith in ethical conduct of fund managers who are expected to keep investors' interests above everything else. While a wrong judgment on a specific instrument can be pardoned as a human error, proven misconduct by fund managers should be dealt with stern consequences. If they are let go of with minor monetary penalties, such tendencies are bound to rise, shaking the very confidence in mutual funds. Investors in equity mutual funds are at least expected to be aware of the risk associated with equities to some extent. Though the fund managers are believed to be experts in investment approaches, time and again it has been firmly established that most of the managers fail to beat their own benchmarks in returns consistently. But investors in debt funds park their precious savings willing to be content with moderate returns and very little surprises on the positive side. Most investors in this category are people who are retired from active life and are solely dependent on returns on their investments. Recent instances of investments in bad securities like ILFS and DHFL have hurt significantly large number of such class of investors, denting the confidence in debt mutual funds. However, many attributed them to genuine judgmental errors and took it in their stride. No malified intentions were attributed to fund managers. The case in point for today's discussion is alleged wrongdoing by Franklin Templeton senior management personnel, their immediate relatives, and associates. In 2020, Franklin Templeton suddenly decided to wind up 6 of their debt schemes, citing liquidity issues. Stung by the surprise development that could potentially hurt thousands of innocent investors, a few of them came together and initiated steps to sue the management for wrongdoing. Market regulator SEBI served notices on the AMC and sought explanations after a few possible instances of wrongdoing came to light. It is now reported in the press that senior management was aware of impending trouble in the schemes and quietly withdrew their investments along with the investments of their spouses and close associates. Apart from keeping it under wraps, a few of them even alerted some of their close contacts to quietly redeem their investments from the schemes beforehand. While innocent retail investors were left to fend for themselves, people with inside information got away with their units fully redeemed. What is appalling is to know that apart from the fund managers of specific funds, their bosses, including Asia Pacific region's head and his close relatives too, walked away with redemptions of very large number of units from the affected schemes. It is only after all insiders got away that the news about premature closure of funds was made public. After a lot of hue and cry and the outrage from the public, investigations were launched and proofs of wrongdoing were reported to be established. SEBI slapped a penalty on Franklin Templeton AMC, asking them to return 460 crores with interest charged as advisory fee. A few individuals are barred from capital markets for a year or two. If people who misuse their position of possessing inside information to redeem their investment without cuts is possible and they are left untouched, retail investors will surely feel aggrieved. And they are not wrong in feeling so. Unless the punishment is severe enough to deter any future misbehavior of fund managers, it might even embolden the other errant fund managers to protect their interests first, shedding their primary responsibility of protecting investors' interests. Mutual fund ecosystem is keenly watching the development in this case, and we as investors and mostly gullible investors can only hope that the justice prevails for investors. However, we hope all investors are treated fairly and equitably at all times and the regulations be amended to provide such a system in a transparent manner.